the presentation that I do, I refer to it as money management and budgeting bracket in the age of COVID-19. Let's get off the title slide here. Anyway, that's me, Richard Haggins, at Senior Education Facilitator, back in the office, which I haven't seen for ages. A little bit about what we do at Credit Canada. Our primary function, we deal with people who come to us, our clients, and our clients basically have one thing in common. What they have in common is they're experiencing what they are self-defining as being money trouble or money problems. How they actually got to that point, there's 1,000 different roads to money troubles, and everybody gets to define for themselves what constitutes trouble. I've had people who've come to me and they've actually had fairly minimal problems, but they're interpreting them as much larger than they are. And I've seen people the other way around where they were taking a mountain and turning it into a molehill. But in general, we're talking about people and their journey through life. This is what I refer to as the big three of life happens. Unless you are a very, very, very fortunate person, at some point as you pass through life, you're going to find one, two, or all three of the big three coming in. Those are the job losses, the income losses, the health issues, and I define that very broadly to include anything that's going to wind up costing you money. Obviously, right now, that's what we're talking about nowadays. And then let's not forget the marital breakdowns, the relationship breakups. These are things that the big three wind up happening to people. And as I said, unless you're a very, very fortunate person, you're going to be saying hello to some of these. Anyway, in addition to that, we have people who life happens, and to some extent, they actually made it happen. They did things that it would have been better if they had stayed on top of things, if they'd made some decisions or not made other decisions. Life could have been different. So there's times where people basically go and trip themselves up. What I do as a presenter, I talk about a variety of issues. The first one we're going to talk about, I'm just going to call money management and budgeting and spending plans. I'm going to talk fairly briefly in general about putting together a money plan for good times, for all times. And then we're going to also tweak that and talk about, okay, well, what about in the COVID-19 era? When Deborah and I were taking a look at what are we going to wind up talking about, we'd settled on a game plan where I was going to talk about, your basic personal finances, because that underlies everything. No matter what's happening in the world, if you're going through life and your income is here and your spending is here, you're going to be okay. And if it's the other way around, if your income is here and your spending is here, it doesn't matter what other people are doing, you are a sinking ship at that point. So we're going to start by talking about that, talking about basic budgeting considerations. Another thing that I do like to make sure we're going to cover here is a little bit on talking about credit reports, credit scores. I am going to walk you through a little bit of a process for getting your own credit, checking your own credit, finding out what's going on. And I'm going to comment on what might be changing in the era of COVID-19. And the other thing that we'd agreed we were going to talk about was I'd characterize this as bad financial decisions you'll want to avoid. Primarily, I'm going to be talking about people resorting to I call them second-tier creditors, organizations that lend money to people who they've exhausted their other resources and they're out there looking for somebody who will, give them a consolidation or do something magical to make their finances better. And they make decisions that later on they're going to go and regret. Well, anyway, we'll get to that when we get to it. So anyway, diving straight into things here because we have a limited amount of time and I want to cover as much as I possibly can. So the area of spending plans, by the way, I have made available to Deborah, I've made the PowerPoint deck, which I am going to go through rather quickly. I've made that deck available to Deborah. So if you would like to have that downloaded, please feel free, not a problem. It is free. It's sitting out there for people to take. Okay. Spending plans. So not rocket science here. We're just talking about income coming in, expenses going out, looking at the difference and seeing what we can actually do with that. So in good times, when I'm talking to people in person, which is what I used to do before COVID-19 came along, I would actually print this slide off and hand it out to people because I use it as a talking point. What I'm going to do instead of, I've broken this slide out into the next 3 slides, where I go and I talk about people and their overall finances. I like to break things into 3 chunks: the income chunk, the fixed expense chunk, and the not so fixed expense chunk. So anyway, let's go 1, 2, 3. Um, Number one, looking at the income area. Now, for some people, they have a stable job, they have a stable income. I'm one of these people who I am paid a salary, and I'm very, very grateful I'm getting a salary because that gives me some predictability. I know that every 2 weeks I'm going to see money coming in, and it is this amount of money, and it's always this amount of money. And that firms up the front end of my spending plan where I know what I have coming in. Now, for a lot of people, and an increasing number of people in the 21st century, they have some income instability. You get the people that work in the gig economy, the people that are, they're in the precarious employment sector. You get the people who are working on contract. You get the people who are working irregular hours. You get the people who are self-employed. And for all of them, it's like the income side of things is bobbing up and down and up and down and up and down. And while I don't have the time to really dive deeply into this, I do need to point out that anybody who's got income instability needs to figure out how you're actually going to handle the down part. When there's more money coming in, congratulations, anybody can handle more money coming in. It's when the bottom drops out of things, when you're going through these slow periods, when you're not making as much as you would have at other times of the year. How do you compensate for that? Some people will say, oh, set up different savings accounts, put money over here, put money over there. That's a bit of an old school way of looking at things. My parents, both of my parents have passed away, but my parents they were children of the Great Depression. And for anybody who knows anybody who was, a child of the Great Depression, they like to hide cash. They like to, put cash in different places. Let's put it in the books. Let's put it in the bookshelf. And anyway, it was a way of making sure that you had something to fall back on when you needed to. Nowadays, find electronic ways of doing the same thing. Move your money around, have different accounts, or figure out what you can actually do to regularize it and smooth out the income flows. I'll tell you before I move off this slide here that if people can't keep the income end sorted out, it leads to a train wreck further down the spending plan. That's where people wind up finding that some of their expenses just can't get covered, and they are forced on different forms of credit. And that puts people on the road that eventually leads to a credit counselor or a bankruptcy trustee, because we just find that the balances on your credit accounts start to creep higher and higher and higher. And you follow it back to the beginning of the process, what you find is issues in here. Okay, let's get off of that slide. Let's talk a little bit more about a couple of other areas. Fixed expenses. Fixed expenses, generally, they are the same every month, although they don't have to be the same every month. When I say fixed, what I'm really thinking about is something that if you don't have the money to cover it, then you have immediate consequences. It doesn't take a rocket scientist to figure out, at least in normal times, if you don't have the money to cover your rent or your mortgage or your let's say your utilities or your car payment or your car insurance or your child care, you can work out for yourself those consequences. They're going to get very ugly and very ugly very, very quickly. I mean, in normal times, you start missing your rent, landlord's at the door. You stop paying your car insurance. If you get pulled over by a police officer, whoa, we have some serious problems at that point. When I'm doing workshops and we're doing presentations or webinars for teens or young adults, this is an area I spend a fair bit of time on, trying to make sure that people are aware that once you actually have something that's fixed in your overall spending plan, once it's fixed, it is a very, very hungry beast. It needs to be fed all the time. And so I like to get people to really think twice before they start signing any contracts. You'd be surprised how many 18 or 19-year-olds, the first thing they actually commit to is, well, they got one of these, and they go and they agree for some sort of a plan, and they're locked into it. And once they're locked into it, then the phone company expects to get paid, no matter what else is going on. They want to see their money. Okay, then we have the flexible expenses. I don't want to spend much time on this, but generally speaking, when we have more time, we're talking to people about getting them to go and track how much money they're spending, looking at possibilities. What could they actually do to reduce things? Um, anyway, the rest of this is pretty much straightforward. Add things up, take a look, how does it actually work out? And then ask yourself, what can you do to maintain the process? Now, in the COVID-19 era, we've gone from regular budgeting to what I'm just going to term crisis budgeting. And I'm going to cut right to the chase here. We did at the beginning of April, end of March, around that point in time, we did a webinar for some of the clients of Credit Canada, where we were taking a look at putting together a crisis budget. And we did a bit of a thought experiment. And our thought experiment was going and taking a look at a budget while cutting the income in half and saying, okay, if something horrific has happened and you just saw half of your income run away, then you put everything under a microscope and say, okay, we're going to throw stuff overboard and we're going to see what can actually be done. Now, this was at the beginning of the COVID-19 era. We put something together, and the numbers are very, very round numbers, as you can see. They're imaginary numbers, but we're trying to represent somebody who had a take-home income of about $4,000 a month, and more or less your average Canadian. Over 95% of their take-home income was disappearing into various expenses. So then we said, let's take a meat cleaver to this budget and see what we can actually do, even if just for a little while. And no apologies for what's going to happen here, because again, this is crisis time. So first off, we said, okay, let's take a look at the temporary deferrals. What comes out of the budget, even if just for a little while? And we thought, okay, fair enough. The housing costs, the car payment, we're attacking the fixed expenses right away. Now, we did at that point in time, we did say that these are temporary. I'm going to actually come back and mention the word temporary again in a little bit. Fact of the matter is that organizations have given people some breathing space because of COVID-19 era, but we are getting to the point where, if you've heard the term deferral cliff, what we're talking about there is that we're going to get to a point where organizations are going to say, well, we really can't defer things any further. So people are going to have to start making these big ticket payments again. Primarily, we're talking about mortgages. And we're looking at perhaps September or October as being the point where these payments have to be turned back on again. How ugly it's going to get at that point in time, nobody really knows yet. But at least we're taking a look at, okay, temporary deferrals, what can be done? And then we said, okay, well, what else can we actually pull out of the budget at least for a while? And I thought, okay, well, these four, let's call these four gone. The maintenance, we're going to cut the gas back substantially, cut the meals out back substantially, leaving something for takeout, and carve down the entertainment as well. And then beyond that, we said, okay, well, what other areas could we go and ask organizations, is it possible to get reductions? So we took a look at internet cable packages, cell phone plans, even car insurance. That we might be able to find areas to cut back there. Then beyond that, what do we have next? Anything else we could cut back on? The clothing budget, we carved that out. The gyms, cut that out. Of course, these are all gradually sneaking back into the budgets again. But anyway, for the time being, we wound up with something where, hey, we took something where we had the income dropping by 50%, and yet we said, okay, let's try to to manage on what's left over. We have an artificial surplus. If you take a look down the bottom there, artificial surplus, hold on to this to catch up later. And we're saying hold on to it to catch up later because it's the temporary factor that, obviously the rent, the mortgage, the car payment, the whatever else, these are going to be coming back and saying, okay, well, we need some money now. Again, I'm going to close out on this area by saying that it's really up to everybody to work out for themselves what is actually doable for people in their own circumstances. So I'm going to leave that with you. Honestly, if in this area there's homework to be done, we're not quite done going through the things I'm going to suggest are homework. But anyway, at least for the immediate time, working out, okay, what can be done there, and then moving on from that point. I have a couple of other slides here where I highlighted a couple of the other areas for the longer term, or for anybody out there who is talking to their children about educating their kids about basic personal finances. At some point, they've got to get their heads around the idea of setting financial goals. Now, one problem I have with financial goal setting is that you pick up any kind of book on personal finances, and it's always this shoot for the moon. Somebody's like, they turned 18 yesterday, and they're talking about, plan your retirement. That's where you lose the 18-year-olds. They're like, oh, they're not ready to plan for retirement. But it is a good time for them to ratchet things back and stop looking at longer term goals and take a look at something shorter term. Because if you can get people to the point where they're actually motivated to do something, it could be as simple as, before COVID-19 came along, I used to talk about taking a vacation in the wintertime. And say to people, January's coming, who'd like to go to Cuba? Who'd like to go to Florida when it's minus 30 outside? And everybody's like, yeah, me. I'd like to go to Florida. Everybody like to go to Florida when it's minus 30. Anyway, so how do you actually make that happen? Because for too many people, what they do is they make that happen off of their Visa card or their MasterCard. They're like, yeah, okay, I'm going to put everything on the card. I'm going to have a good old time for a week while I'm down south, and I'm going to come back and I'm going to look at my bills and I'm going to pass out. So having people think about things before the actual expense comes up, if you can get them to do that, that's good. That's big step in getting people to not wind up on the road to leading to me. Saving tips, I thought about adding a bit more here, but then I thought, no, okay, let's just deal with the immediate issues. But everybody needs to figure out some way of how do you hang on to your own money. I've heard every story under the sun. I've met people who were they were transferring money out of one account at one institution and sending it halfway across town just so they could actually keep their hands off stuff. I encountered a gentleman beginning of this year who said that to be able to hang on to money, he said if he kept it in his own hands, it would get spent. So what he was doing was he was giving all his excess money to his girlfriend. And I thought, I hope she's very trustworthy. I hope she's not actually going and spending all your money for you. But he said best option for him was to hand everything over to his girlfriend. So if that works, great and wonderful. If not, well, problem. Okay. A couple things I want to say in the area of credit usage, and then getting into credit report, credit score. So let's have a quick look at the issue of, credit itself. It's a tool. It's nothing more than just a tool. And as a tool, it can be used well, it can be used badly. And when you're using credit, again, you need to be aware that there's a cost associated with it. Now, I truly do hope that if you are accessing credit, you're using what I refer to as first-tier lenders. First-tier lenders are the organizations that we're all very, very familiar with, the big banks. If you're not a fan of the big banks, great, wonderful. Look at alternative options. Take a look at credit unions. If you're unfamiliar with credit unions, the bigger ones in Ontario, we've got Meridian, we've got Alterna, First Ontario, Duca. There's a bunch of other ones out there. If you just Google the term credit union, you'll find out what's actually operating near wherever you happen to be. You do have options, but what we're looking at is we're looking at doing business with organizations that don't charge outrageous amounts of interest, as opposed to what I call second-tier lenders. Now, something that I found really uncomfortable and unpleasant was right around the time that COVID-19 started to take off, back in the back half of March. According to TransUnion, which is one of Canada's two credit bureaus, the inquiries going to second-tier lenders spiked up about 34% in March. That's an awful lot of people who were going out trying to access credit because they realized they had money issues, they had money problems, and they had already burned their bridges with first-tier lenders, so off they went talking to second-tier lenders. The issue with second-tier lenders is, well, it's going to be the interest rates. I just mentioned first about subprime, but this is being offered to people who they don't qualify for anything conventional. Maybe it's their income, maybe it's their credit history, maybe they're already carrying too much debt as it is. But anyway, they don't have the option to go anywhere else, so they are looking at the interest rates that are being charged by second-tier lenders. Now, again, I have a little bit of I have a couple slides in here where I call this "Let's Run the Math." Let's run the math. I visited the website of a Canadian organization. I'm not going to tell you who they are, but they're a Toronto-based organization. I know I've seen their advertising inside the subway on the Yonge Street subway line in Toronto. I've seen their billboard. I've seen their advertising on billboards. I know I saw one near Sherway Gardens some time ago. Another one near the Toronto Premium Outlets, which is in Georgetown. 401 and Trafalgar Road, that area. Anyway, they offer loans to people who one of their search terms is bad credit loans. And so I visited their website, and I'm just going to give you a little bit of disturbing information here. I'll run through this for a second. Let's say I need some money, and I want to borrow, and I've just taken some numbers from their website. I'd like to borrow $5,000, please and thank you. And I can use this little calculator on their website. And anyway, it says, Richard, you're going to borrow $5,000. That's okay. And you're going to be paying back $133.45. There's your repayment. You're going to pay that biweekly, so every 2 weeks. And you're going to pay that for 60 months. So that doesn't look too bad right now. It's got, you're getting $5,000 today. Sounds nice. You're paying back close to $10 a day. I mean, it's like 133 every 14 days. It's $9 and change every day. So $9 and change every day. Like a lot of people spend $9 a day at Tim Hortons or Mickey D's or whatever. It doesn't sound that much. And anyway, nobody's actually done the math for you, but here we go. I'm doing the math. That's what it winds up being. So you remember you got your 5,000 there. 133.45. If you don't believe me, you can get yourself a calculator. 133.45 times 26 times 5 is 17,000 and some change. So you borrowed 5, you paid back 17, and that's how math works. It's grade 4 math, but it's grade 4 math applied with annual interest that's at subprime levels. In case you've ever wondered whether that's legal, yes, that's legal. Here's what the law says in Canada. Criminal interest rate is a rate that's above 60% as an annual interest rate. The example I just showed you there was about a 47% annual interest rate. So anyway, if you don't believe that, again, it's Criminal Code of Canada, Section 347. Consider yourself now properly educated. When I was talking about bad financial decisions that you'll want to avoid, I was thinking in terms of people accessing credit and not really understanding, the downstream costs of that. Your best investment in life is often a calculator, a simple little calculator where you actually say, I think I'll run the math on this. And sometimes running the math gets you backing out the door. We're like, yeah, I don't think so. Now, one other thing we better make sure we're dealing with before we run out of time here, credit reports. So, credit report, I don't know how many people out there are watching this, and I don't know how many of you have already, you know how to check your own credit report. If you do, great and wonderful, excellent, fantastic. For anybody else out there who is uncertain about this, okay, there are two credit bureaus in Canada. One is called Equifax, one is called TransUnion, and they collect information about you, and then they share that information with a variety of organizations, including banks, other financial institutions, landlords do credit report checks these days, potential employers in some industries check credit reports, utility companies, insurance companies, organizations that have that are able to establish that they have a valid business purpose to check a credit report. Now, I'm recommending nowadays for checking your own credit, number one, find out whether or not your own bank, wherever you actually do your banking, are they offering any free electronic way of checking your own credit. I'm going to use the example of one of the big five. Actually, I generally not supposed to mention which organization this is, but this is actually a cut down slice from the Royal Bank website. If you're a customer of RBC, next time you log in, look around the screen, find the My Services area. If you bank with another organization, find out what they're offering. But it says here, this view your credit score. And if you click on that, you're going to find that, oops, click on that, back up a second. Three things. You click on that, you're going to find you get your credit immediately. It is free. And by the way, there is no effect on your credit. I know a lot of people have heard that, oh, if I check my credit goes down. Soft inquiries don't make your credit go down. So soft inquiry is an informational inquiry, not an actual I am borrowing money. So you click on the link there, and here's what you get. You wind up getting something that looks like this. This is TransUnion's Credit You dashboard. It'll show you a score. The score is a number somewhere between 300 and 900, and it'll also show you where you stand relative to everybody else. Now, credit scores run from 300 to 900, but if you take a look at the distribution over here on the right side, we have five, these are called quintiles. So there's 5 quintiles. If you take a look at the top 4 quintiles, they're all packed in between 700-ish and 900. That's like 200 points to the top end of the curve, and that's 80% of all people are squashed in there. They're all squashed in there because that top 80% is what we consider to be good credit. There are different cutoff lines for what is considered to be good enough. I'll use the example of CMHC, Canada Mortgage and Housing Corporation. So if you're trying to get mortgage insurance, nowadays they're saying we want to see a credit score that has to be at least 680. So that's pretty much the top 80% of all credit scores are above that cutoff threshold. If you're seeing a credit score that is 700 or higher, that's it. You're done. Don't worry. Anyway, so let me just mention a couple of other things here. That is the score. Now, the score comes from the information in the report. Actually, back up for a second here. This Credit You dashboard is showing you the score. There's a link up here for the report. And if you click on the report, it'll give you more information. It'll give you a summary, some personal information, show you what inquiries are made, show you what accounts show up, and show you if there's anything in public records. The real guts of the credit report is what's in accounts, and it'll show different types of accounts, and it'll show balances and the dates and the payments that were required, and it'll show you something about in terms of the rating. A rating is a way of talking about, are you making your payments on time or not? And this is like the rating scale. The good number on a rating scale is 1. 1 means you're paid as agreed, you're up to date. Now, I know we're getting into question time here, so I just want to just show you a little bit more about that number there. That's coming from a formula. You may have heard the term FICO formula. FICO is the name of a U.S. corporation, And it's named for a couple of mathematicians about 60 years ago who came up with a credit scoring formula that looked at 5 factors. Yeah, I've got a little pie chart here, and I'm just going to blow up the pie chart and show you what actually goes into that pie chart. So, biggest piece, payment history. 35% of that score is coming from, are you making your payments on time? You remember the ratings here, right? Okay, I put a gold box over the 1. 1 means you're paid as agreed and up to date. So you want to know how to build your credit. You need to have something where you are showing that you are paying your bills on time. Now, some people in the COVID-19 era they're doing deferrals. And if you are doing deferrals, you want to go and check your credit and make sure that it's not showing anything delinquent. So you could actually have a payment deferral, but they're still showing you as last rating as an R1. You just don't want to see anything below R1. And as long as they're holding everything at R1 and showing your payments being deferred, you're good, you're fine, you're not doing any damage, relax, your credit's still going to be staying okay. Other than that, what else factors into it? That other next big wedge is called credit utilization. And credit utilization, that's 30% of your credit score. And let me just give you a really, really quick math example of what this is going to look like. We're going to use something as a very, very simple example. We have Mr. or Ms. Average Canadian. We're going to give them 1 credit card, $5,000 limit. They go out, they spend some money, they put $500 on the card. They're at 10% credit utilization. 500 divided by 5,000. Let's say Mr. or Ms. Average Canadian decides, oh, let's spend more money. So now we've actually used up half. So now we're at 50% credit utilization. So 2,500 or 5,000. And then we say, let's go and spend more money, and let's jump it up to 4,500, which takes us up to 90%. Here's how the world sees you. If you're using the bottom 1/3 of your credit, you are no risk. And if you're in the middle 1/3, there's some risk associated with carrying balances consistently that start to get a bit higher. But here's the bad news land when you are actually running up in the top 1/3. The closer you get to 100%, if you're staying up around 100%, what you're doing is you're weakening your credit because it looks like you are handling your finances less well than you should be. A couple of other areas there. 15% of your credit comes from how long you've had credit. If you've been managing credit quite nicely for quite a number of years, your credit score is gradually going higher and higher because you look like a safer person. You also get a credit bump from the ability to mix different forms of credit. If I just go back to this accounts where we have revolving accounts, installment accounts, other accounts, you can see sort of things like a Visa card, a car loan, a cell phone. The point here is, can you remember to make your payments across everything? If the answer to that is yes, congratulations, your credit score goes a bit higher. And the part that people often wonder about, the inquiries. It's only 10%. What happens there is, as long as you are being careful and judicious in your pursuit of credit, that is really not going to affect your credit substantially. A mortgage broker told me some time ago, if she was looking at somebody's credit and they'd had, let's say, 1 inquiry that had gone through in the last 12 months, she said their credit score might be between 2 and 10 points lower than it would have otherwise been. But for most people who are up in that 80% that already have good credit, 1 or 2 or 3 inquiries every year is nothing. What you don't want to look like you are somebody who is desperately seeking credit because you are going through a crash and burn. And that's the other thing to keep in mind in the COVID-19 era, that if you suddenly lose your job and then you think, I think that, to muddle by, I'm going to open up a couple new lines of credit and 4 new different credit cards. Whoa, that's like telegraphing to the world that your house is on fire.